It does not have to be a physician. It could be anyone, obviously, that they're looking at potentially investing with. I think it's just being genuine and authentic in what you say. And we know you have to know and trust somebody.
Welcome, everyone, to our Hero Capital show. I'm your host, Tim Mai, and today we have another amazing guest on the line with us, Dr. Chirag Chaudhari. Hope I pronounced your name correctly. He's a physician turned real estate investor, turned syndicator, fund manager. Chirag's portfolio spans long-term and short-term rentals from Maryland to Florida and scaled up to institutional grade projects. He's a general partner in 787 units of hotel to multifamily conversions, multiple land syndications, ground-up developments, as well as a short-term rental fund, oil and gas fund, prefer equity deals. He's also a limited partner as well on 20 plus different assets. Chirag's superpower is translating complex cross asset strategies into practical frameworks for busy professionals who want asymmetric upside without losing their day jobs. His mission is deeply relational, helping friends, family, and colleagues grow alongside him by co-investing in the kinds of projects that most people never get access to. So, with that, let's welcome Dr. Chirag Chaudhari. Welcome.
Hey, thanks so much, Tim. Super excited to be here and meet all of you and your team and everyone that's part of the Hero Group.
Yeah, I'm excited to interview you because I know that in a very short amount of time, you've been able to raise a lot of capital yourself as well as with your partners, and how you're helping other physicians really tap into our real estate syndication and fund space. And so, thank you so much for being on with us today. Let's start out with you can share with us a little bit about your journey. What had you go from ER to real estate investing?
Yeah, absolutely. So I'd always had a passion for real estate, but was not really intelligent necessarily in what I was doing. And so starting off as a young attending and not believing as much in the typical structure of you put your money into 401ks and 457s or whatever you have access to, if you will, money jail, where you get a number of different sort of assets that you can choose from, and that's it. And then you don't get to enjoy that until you're 65. And so that always rubbed me a little bit wrong. And so my wife and I, very early on, just within a few years of me becoming an attending, started investing in long-term rentals. And so we would get a bonus, we'd buy a property, we'd get a bonus, we'd buy a property. And within 5, 6 years, we had a number of properties that we were managing. And that's really how we started. I was busy. I was a busy doc. I wanted to pay down loans, and we had absurd amounts of debt and things that we wanted to try to get rid of. And we joined a nationwide home builder. And anytime they built homes, they would have a model home, for example, but they didn't want to own the model homes. They would sell them to investors. And so the investors would buy the model homes and then they would, quote unquote, live there and use the model home to sell the community, which could be anywhere from 2 to 3 years. But that's 2 or 3 years. You don't have to deal with a tenant and you're getting monthly rent checks, which are typically above market. And so that's what we did for the first decade or so. We just aligned with builders and bought up model homes, and it made it easy to be a landlord because there was nothing to landlord. You were just collecting rent checks. So that's how we started.
That's amazing. Okay. And then part of that too, was like having the active income that you have. Did you guys try to also become a real estate professional and get the active income tax off that way as well?
Yeah, that would have been ideal and something I'm still striving to be able to do. I think I'm getting closer, but to hit those 750 magical hours where it has to be more than your day job, I'm still a full-time practicing physician. I do admin work at the hospital, and so it just becomes exceedingly difficult to be able to get reps. And definitely on the trajectory, maybe in the next couple of years, but it would be hard to get those hours, at least for what I'm doing.
I see. Okay. And so share with us a bit about how you went from the rental houses space to expanding into the syndication space and even outside of real estate into oil and gas, land, mobile home parks, and things like that. I'd love to hear your thought process around how you decide to expand, what to expand into, and such like that.
Yeah, so I think it was around 21, actually. I was doing more administrative things in the hospital. I was the chairman of my department for 8 years or so. I was the president of our medical staff, and that was my trajectory. And had a position open up, the associate chief medical officer position, which, at least for physicians, the height outside of, being a CEO or something is the chief medical officer. So I thought that was my
Mm,
trajectory. Narrowed it down, came down to two people, and the person who was in the CMO position at the time sat me down and told me I didn't get it. And that was the first time I'd been told no ever, not for interviews, not for med school, not for residency, not for my job. And so it was a big gut punch, and that door, at least in my mind, closed. And I said, if not that, then what? And that's when I really started getting more and more passionate about real estate, knowing I'd always enjoyed it, but I was doing it just in one sphere and I wanted to see what else was out there. And so I took a lot of courses. I joined a number of masterminds with other physicians in real estate and then started doing things actively and happy with that. But I didn't want to add more time, more energy to the active management. And I wanted to get into passive opportunities. And so I took a course about learning about passive real estate, how you do due diligence on deals, and what it entails to try to figure out what may be palatable as a passive investor. And so immediately following that, jumped into 5 opportunities. Now we're in 22 opportunities, just my wife and I,
wow.
limited partners in a bunch of different assets. And so that's allowed us to really get educated on a variety of different things and been able to add that passive component to my active side too.
I see. That's amazing. And then along the way, like how did you got the idea or expand it into inviting friends and family to invest alongside with you?
Yeah, I think some of the opportunities that have been doing really well and performing well, I'll tell friends, I'll tell family members about, and it was very organic. They would say, "Hey, can I do that too?" I was like, "Sure, here's a phone number, here's a website. I've done my due diligence. I'm jumping in. I think it's a solid deal, but definitely check it out for yourself, see what you think." And so they would start jumping into other deals too. And then it became more and more people. I said, maybe we should talk to them about coming in cumulatively with a larger amount.
Mm,
And there's power in numbers. Can we negotiate a better term and a better deal for all of us? Because we're no longer coming in at 50K or 100K. We're coming in at a million, 2 million. And so we'd go back to our partners and sponsors and different operators and say, what does it look like if we bring you X amount? Can we get a better profit split, a nicer waterfall, whatever the case may be, so that we do a little bit better? And so that's how it started. And then it's grown over the last couple of years.
I see. I love it. Yeah. It usually happens that way, right? Very organically. And the next thing you know, a lot of friends and family wants to come along. So share with us a bit about your quote unquote buy box. What do you look for? Because you have now invested in a 20 plus 22 different assets and even outside of real estate. Give us an insight into what are you looking for? What is your investment box, investment criteria?
Yeah, so it's interesting because it's pretty widespread and it really depends on the asset. Our buy box comes from friends and family and what they're looking for. And so that's varied a little bit over the years. And we have some that also have active real estate and they want that depreciation and that passive loss through a nice negative K1 where they can write off some of their passive income. Others want reliable monthly cash flow. And so we've tried to find those opportunities. Others don't care at all about cash flow. And they're like, take this money and make it as big of a pile as quickly as you can. And that's their buy box. And so you try to find something that fits that. And then we have others who have no interest in real estate, don't want anything to do with running a short-term rental and getting that tax credit or doing anything active. They enjoy their day job, but they're just looking for some mailbox money, if you will, some kind of a side hustle with some cash flow. But they also want to drop their taxable income and their active tax. And we can do reps, like you mentioned, to drop your active tax burden. You can do the short-term rental tax loophole and get Airbnbs up and Burbos and things, or you can do energy opportunities, which will let you offset active tax. So the only reason we did oil and gas and got into that is because we had a number of investors come and say, look, we need to drop our taxable income. And so oil and gas is a terrific way to be able to do that.
With us coming to the end of the year here, I'm sure you've gotten hit up even more than normal about people needing to offset their taxes. Is that correct?
Yeah, no, absolutely. So I think you're spot on. It's a great opportunity in the last quarter of the year. People are thinking about taxes and what they're going to have to pay this year. And so, yeah, anyone that invests in this calendar year gets that offset of their active taxes for this year, which is great. And they'll get an immediate return on investment when they get their tax return, when they file that. Yeah, it's a great feeling. And it's government backed, government supported, right, by the IRS, by the tax code. And it's a nice way to have that insurance policy against a complete loss, which is what we always worry about in these deals.
And with you being a physician, are most of your investors also physicians as well?
Yeah, I would say the vast majority, probably 75 to 80%, yes. And we have other folks that'll raise with us and bring in their friends and family. We have attorneys, an economist, and other folks, a dentist that will sometimes bring in some others. But yeah, by far and away, it's physicians that'll come into our opportunities.
What and are they just purely people that you know, or have you expanded where you're more actively marketing for them?
Yeah, I think initially it was just folks that I knew and that sort of knew what I was up to. And then it's become friends of friends. And so that circle gets a little bit bigger. But you then get to a point where you have to start, I've talked to everyone I think I know. Now, who do I talk to? And is there opportunity to make that circle even larger? And that's what you're trying to figure out. But a lot of it starts very small and then grows.
And I know when you booked this call, you mentioned you raised over $12 million dollars yourself. And then with your partners, you guys have raised over $60 million dollars just this year. What does when you are looking to expand your network and reaching out to your partners, do you also look for other physicians as potential partners? What are some of that criteria? Do you try to convert any LPs who is like a seven-figure investor? Hey, if you're going to invest that much, you might as well come on and help raise as well. Or what is that process?
Yeah, I wish I knew some seven-figure investors, and if you know any, I'm open to conversations. But no, I think most of the fee, we're just comfortable. I'm a physician. I'm comfortable speaking with other physicians. We speak that language. Some of them will speak the real estate language and the syndication language as well, but a lot of them don't. So we tend to be very conservative and fearful by nature. And so I think we're not very trusting of others, but we trust one another, right? And so being able
Mm.
to speak to another physician, have that conversation to where they understand what you're going through, some of your difficulties and your pain points, be able to relate to those, but then also say, hey, here's the opportunity, here's why we think it's good, here's the level of due diligence that we did. And never is that an excuse for not doing their own, but there's some comfort in the fact that we've spent 4.5 months deep diving into an opportunity with the sponsor with that specific deal. So I think that brings a lot of comfort. But no, I think to answer your question, not really gone outside of that community much because I don't really know a lot of other folks in other communities.
I see. One of the things that you mentioned, I'd love to dig further into it. You said that like physicians, they have a hard time trusting others. I noticed that dentists, they're a lot more entrepreneur. They seem to be more willing to take risk than physicians are. And I'm also assuming it's because you guys get hit up from a lot of different service providers and other deal sponsors and things like that. But give us insight into the minds of a physician. What does it take to win over their business? And yeah.
Yeah, no, I think that's a really good point. And I think part of that, unfortunately, is inherent in our training. And through medical school, you don't get business
Mm,
training. Nobody talks to you about putting up a shingle and setting up an operation. That's very different in dental school, where that is talked about. And running a practice is very important. Some of them offer MBA programs through dental school. My son happens to be applying to dental school right now, which is why I see this little bit of a dichotomy in training. But yeah, physicians don't get that. And we come out of medical school and we're immature and we're vulnerable and we're in residency and we don't have any financial training. And you get financial advisors and other folks that sometimes have different initiatives that they're looking for. And you're a young and available audience. And so you get roped up into financial planning that may not be as great. And I think part of what I do is, or I hope to do, is be able to tap myself on the shoulder 10 years ago and say, hey, there's this
mm.
whole world of opportunities out there where if you read about it and educate yourself, you can do really well. And so that I think is definitely super, super important to do. And I don't think I answered your question, Tim. I started going off on the dentistry thing, which I think you're spot on. I think they're very entrepreneurial, part of their training.
Yeah, I'm just curious to, what it takes, right? It's like you mentioned, because you're a physician, you talk the language that other physicians talk, and with that commonality too, it's easier for you to win over their trust. I'm curious as to what it would take for a non-physician, non-doctor to be able to tap into the physician's niche audience.
Yeah, I think honestly, I don't think you need to be a physician at all to be able to speak to them. And I think they're altruistic by nature, right? And they want just abundance. And I think if you come in with just offering, whether it's knowledge, whether it's tools, whether it's a course, whatever that may be, to offer up education and offer up learning to them, I think that would be very well received. I think they're lifelong learners. And I think we're curious by nature, and that would appeal to them, I would think. And it does not have to be a physician, it could be anyone, obviously, that they're looking at potentially investing with. I think it's just being genuine and authentic in what you say. And we know you have to like know and trust somebody. And so I think that's just being yourself honestly and speaking openly about what you have to offer, what you've known and what you've learned. It goes a long way.
That's good. Thank you. So what kind of education do you do? Like, is it a monthly webinar? How do you educate and nurture your investors?
So I do a monthly newsletter where I try to put something educational in there most of the time. It'll be sometimes if we have an offering, we'll put that in there too. Every other month, we like to do just an educational webinar about different asset classes, different ways to be. We have one coming up next week, actually, just about how to be a good sort of thoughtful investor. What are the questions you ask? This one happens to be about multifamily, but it could be about anything. But how important is it to look into an asset and not just look at the deal deck that somebody's showing you? How do you dig into that? How do you verify those numbers? Trust but verify, and not just look at a marketing deck, because that's what it is, a marketing deck. You can make the numbers say what you want. So that'll be nice. It'll be educational. There's no pitch. It's just come learn about multifamily from one of our partners that we haven't worked with before. We hope to at some point in the future. But yeah, it'll be great. But try to put those on at least every other month or so.
I see. And do you offer your investors an opportunity when they see an investment opportunity that's out there being emailed to them that they can forward it over to you and get your feedback, your take on that? Does that happen a lot in your work?
Yeah. Yeah, absolutely. I think people know that I'm willing to, because I've made my own share of mistakes and I've been doing this long enough to where I can much more quickly look at something and give them some feedback and never want to discourage anyone, but very openly and honestly say, here are the questions I would ask. Here's what I don't see here, because we all have blind spots, myself included. And it's so nice to have somebody else look out for your blind spots. And so, yeah, always happy to do that.
I see. Okay. What is your average check size that your investors invest?
Yeah, it's so funny because the deals will have varying minimums and we'll sometimes adjust the minimums based on how many investors we think are going to come in and things like that. And on average, it's the minimum, right? Whatever
Oh,
we often set the minimum as, that's going to be the average of who comes in. There's always going to be people that come in somewhat higher, but I would say overall, probably 5K, 75K
okay.
to 100K is probably going to be our average check writer.
I see. Have you considered raising your minimum and then just make exceptions for the ones that, don't meet the minimum? And let's say you raise your minimum to let's 150,000 as an example, and someone says, "Hey, Shirag, I only have 50,000. Can I still come in?" And you make exception for them. Have you considered doing it that way?
So we do that now. And
Okay.
so so we'll have a number of raisers. Let's say there's four of us potentially raising for any one deal. We'll say each of us gets to bring in somebody at half the minimum or two people at half the minimum. So we limit the numbers of people that we allow in, and we allow each particular sort of capital raiser to come in a little bit lower than the minimum. And that's really for people who are new to syndication, new to being a
Right.
limited partner. They want to dip their toe in the water and do it at a smaller amount. Normally, we'll tell the sponsor or our partners that we're going to raise a certain amount of capital. And so we can't make too many exceptions because that diminishes from the overall pot that we're able to collect. But we do that now because I think it's important for those folks that have not done this before and that are new to alternative investing, which I disagree with that term. I don't think there's anything alternative about what we're doing. But I think for folks that haven't done this before, it's important to give them a little bit of leeway.
Okay. And do most of your deals, do you come in as a fund of funds or do you come in as a co-GP on the deals?
So it depends on usually the amount of capital that we've decided we're going to bring into an opportunity. Most of the time we're an SPV when we come into a deal and we just come in as that fund of funds. But many times we've come in as JV partners. We did a land deal earlier this year where we brought in 23 million of equity, so about almost
Nice.
half of the total purchase. And that got us to be a TIC partner. We're on the deed. All of our investors are on the deed. And so it's comfortable when we're able to bring in sort of those larger amounts. So we try to be a JV tick when possible, but sometimes absolutely
Ah.
we're just fund to fund.
Do you have a goal as to how much money you want to raise per deal?
No, honestly, it varies by deal. It varies what our partners are looking for. Some deals don't require a lot. For example, we did a pref equity deal where they just needed 2 million and they didn't want to go to a bank and pay higher interest, but they were willing to pay our investors 12%. And we did a 2 million raised for just a straight pref equity deal, which is very safe, very comfortable for those investors that just want a solid return. And then we'll do significantly higher ones. We do want to raise, our goal for next year is to be able to raise 200 million. And so that's where we're setting our sights. We'll see how close we get, but you got to have a goal.
Right. So with the 200 million goal, you want to get in as many of the tick deals as the JV deals as possible, and then the rest as a fund of funds. Is that correct?
That's right. Yeah, we're
Very
hoping to
cool.
do 2 deals a quarter. At least one deal a quarter will be a repeat deal that we've done
Mhm.
before with a partner that we've worked with. And then one new asset class a quarter is the other goal. And so we've done so many different asset classes now. We've done pref, we've done a hotel to multifamily conversion, doing an oil and gas now. We've done a number of land deals. And so we're looking at storage, we're looking at a mobile home park, potentially a build to rent. And that way, none of our eggs are in any one basket. We're not correlated with the other assets. Our investors the same way are diversified, if you will, in a number of different asset classes, which we think in the long run is good as opposed to being isolated in one particular asset class.
Okay. It sounds if you're doing a couple deals per quarter, that's not a lot of deals to get to the 200 million in next year. So that means that each deal you're investing pretty significant amounts per deal. Like,
Next year is the goal. Yes. Next year is we look to be doing larger amounts than we have been.
yeah, because at that amount, it's almost like you're in at least 50% of the equity on most of these deals, it sounds like.
Yeah, most of the deals we're bringing in all of the equity,
All of the equity.
minus a little bit of the skin in the game that our partners would have. But most of
Yeah.
the time, we want to be able to bring in all of the equity because
Okay.
that gives us the ability to negotiate really good terms for our investors when we're able to bring in that quantity and have them do what they really want to do, which is operate the asset. Some of them want to do investor relations and talk to LPs, but by far and away, most of them just want to do what they're good at, which is asset management.
So when you're raising, let's assume that you're gonna be raising 100% of the equity minus whatever skin in the game that the deal sponsors put in. Do you get to control what that economics look like for the LPs, the waterfall and all of that? Or because you're coming in at that point, you're coming in as a JV. Is that the correct structure? So you pretty
Yeah,
much have
yeah.
voting, yeah, you have everything that a normal deal sponsor would have, right?
Yes, I would say voting rights, we still want to defer to expertise, right? And while, yes, we're bringing in a lot of the capital, we are not the experts in drilling oil and gas. We don't pretend to be. We don't want to necessarily have decision-making authority because maybe our decisions are not the greatest ones. But what we'll do is we'll find ourselves a seat on typically an advisory board, which we're on a couple of advisory boards for bringing in the amount of capital that we bring in. And so, yes, major decisions, all purchases of any wells that we're doing in the oil and gas deal, we have a yay nay to. You know, how strong our nay is, I don't know. I don't know that it's that strong, but we hear about it. We're part of that decision-making process, which is important because of the amount of capital we're bringing in. Yeah, to your point, we want decision-making authority and are able to have varying levels of that.
That's good to know. And then in terms of what your fee structure look like as the lead partner, is it pretty standard? Because, and let me explain why I'm saying this. I've interviewed another fund manager. His structure is a little bit different. When he's bringing on investors, they are truly just investing alongside with him. He doesn't have any fees. He doesn't make any money on them. Do you have that kind of structure, or is your structure like you are as the lead partner or fund manager, you have certain fee structure and then your LPs get what they would get as if similar to if they invested directly into the deal?
Yeah, no, so I think really good question. And I would say our structure depends a little bit on the deal. Some we have to align with our partners because they may also be raising their own capital at times. And so we do have to align with them because our PPMs are somewhat aligned. And so that structure remains somewhat similar. We have done several now where we've been the sole capital raisers, where we've been able to structure that in a very favorable way to LPs. And so we're able to structure it so that, yes, there's fees involved, there's an acquisition fee. Typically, our acquisition fee just rides along in the deal, though. We don't actually take it, it just becomes an investment. But there's an acquisition fee, there's management fees that are probably commensurate with what's standard. But we try to do the returns so that there's no sort of loss of return to the investor until capital is returned. We're able to engineer waterfalls in their favor. We're able to do things in the PPM where we say, look, we can change the waterfall, never in our favor, always in the investor favor. Even though it's written like this, we can make it more favorable. We do a charitable component to all of our raises, and that doesn't come out of any of the investor return. Part of the GP return or the fund to funds return is earmarked for a charitable investment. And so we think it's important to give back. So to be able to create all of those various kind of structures within a waterfall is really nice. And so part of that is being able to raise that amount of capital. You can carve out different pieces.
I love that. And then who decides on the which charity causes or organizations you guys invest in? Is it you and the core lead fund managers, or do the LPs get a say in that as well?
Yeah, that's a really good thought. We have not opened it up to the LPs to decide. We typically have that sort of already decided once we start raising. To be fair, we don't tell a lot of LPs that we do that because
Oh,
that shouldn't necessarily change their decision whether or not to invest. The deal is the deal. They should be looking at the economics and sort of the downside risk and what's important for them. If they ask, we'll tell them. For oil and gas, we have two sort of environmental causes that we're going to be contributing to, but it's our raisers that choose those. I like that suggestion to open it up to the LPs. That may be a good idea.
very cool. Wow, this has been a really interesting interview, learning more about your business. So to hit the 200 million in 2026 here, what are you going to be doing differently to hit that number? Because 200 million is not a small amount. That's a huge amount for most of us. I'm curious as to what your growth strategy look like to make sure that you hit that number.
Yeah, so really good point. And we are trying to grow. There's four of us we put all these deals together. And so I'm one of four. And so the four of us meet every single week. We have a business meeting. It's Sunday morning, so we call it church. And every Sunday we meet and we discuss the business and discuss what we're going to do. And so just this morning, we're bringing on an executive assistant. So we started our interview process today, trying to get out more and get more FaceTime because we're a little bit socially awkward and we tend to hide and we don't want to be on social media touting about things we do. And some W-2s don't appreciate that either. They don't like you having alternative side gigs and doing things
Right.
outside of medicine. And you have to be a little bit careful, but I think it's a hobby. Call it a hobby. It's something that brings us passion. And so I think we're going to get more comfortable with talking more about what we do because it's great and it's helping a lot of folks. And so there's no reason to hide about that. So I think it's finding podcasts, webinars, and meetings like this where we talk a little bit about what we're doing. And hopefully it helps others do some similar things.
That's good. I love that. With you have started as an LP 4 years ago, you were pretty much at the height of the market. And so you get to experience some of those deals. I don't know if you have any deals that are in trouble, anything like that. And then, now coming on to this market that's turning around here. I'd love to hear your thought on where the market is going. What are you doing to help take advantage of where the market's going and also mitigate some of the downside risk as well?
Yeah, no, I think it's a great question. So my first two investments as an LP went to zero. And it was a
Mm.
complete loss of equity. And there were capital calls, and I'm doing CPR on this deal because I didn't want it to end and trying to resuscitate it, but it was unfortunately not to be had. And it's funny, I talked about that in one of my newsletters and saying, this is the risk. And granted, my due diligence is light years beyond what it was when I first got into deals 4 years ago. And we do things very differently when it's other people's money as opposed to just my wife and I. Now our due diligence is absurd, just like I imagine yours and everyone else's on the call is. But it's hard to have that happen. But I think it makes you appreciate what we're doing and how important it is to know that you're getting into opportunities that you're backing, that you've looked at every possibility and what can happen. And so I do appreciate where we're at now in the market. And I do think things are turning. I think there's folks are holding on to a lot of cash and they're waiting for opportunities that they think are going to do really well. For whatever reason, in the last 2 to 3 months, there's been a big drop in the ability to raise capital. I think at least we've experienced. People are holding on a little bit harder right now. It's a little bit unclear to me exactly why, but I'm sure the economy, the shutdown, and other things are playing and weighing on people's minds, and they're holding dollars a little bit closer. But I think that's 6 months, that's going to change pretty impressively. It's funny, we had maybe 2, 3 months ago, we had a raise that we opened opened up. And it was on the heels of one of our land deals that had, within 3 months, returned almost 25% of investor capital. And so people got flush with capital from an investment very quickly. We had another land deal that was open. We opened it at 1 o'clock Eastern. We had $8 million dollars in 2.5 minutes into our portal. I
Wow.
thought we broke the portal. And
Wow.
so we oversubscribed. We had their engineers pull out by the second when the investments came in. It was like an Olympic shot clock, like how quickly they were coming in, but it was absurd. So that was within, by that evening, we had double subscribed the deal, and that's not happening anymore. We're not seeing that. And so, yeah, it'll be interesting, but I do think that's coming around again, probably end of first quarter next year. I would think that the raise ability is going to be pretty high again.
That's great. Okay. In terms of your two deals that went to zero, any major red flag you can think of now, like looking in hindsight, that you should have caught the red flag when before you even invested in the deal?
Yeah, so I think not predicting. I mean, they were interest-only deals. They had these arms and they had to buy rate cap extensions and all of these things that so many sort of sponsors went through during that period. That was a little bit unpredictable for how rapidly interest rates were going to rise and unfortunately not survivable. What I learned though was how not to treat an LP, because the
Mm,
communication from the sponsors in those deals was pretty terrible. And it's fine that I think investors understand that there's risk, and to just sugarcoat it and pretend like it's not happening and not be as transparent with investors as possible is terrible. And I think it taught me how not to be when it comes to communication, when it comes to just open transparency, and nobody's hiding anything. The deal is what it is. You have to share all the numbers in your due diligence. And if it's something you walk away from, you be very open and honest about it and why you're doing that. But I think it's important. And I think all of us that are looking at these deals should share that with one another openly also, because I don't know that we do that enough.
I see. Very good. All right, Shirag. For those that wants to, before we open up for Q&A here, for those that wants to reach out to you, connect with you, whether learn from you, invest with you, maybe co-race with you, where would you like to send them?
Yeah, so my website is thesyndicationdoctor.com. My
I
email
like
is
it.
thesyndicationdoctor@gmail.com. You can get me on email. But it's funny, I was on stage and talking at Raise Fest earlier this year, and they're like, "How do people get a hold of you?" And I was like, "I just gave them my email." They're like, "Nobody can spell the first three letters of your name. That's not going to work." And they're like, "You need something simple, something easy." So within a week, had a little landing page set up, and yeah, it worked.
I love that. Dr. Chirag, thank you so much for being on with us today. Really appreciate you. I love your success and yeah, your growth for 2026 here as well. Thank you so much for being on with us today.